Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Radhika, Economist, Senior Vice President at DBS Bank, joining in. Welcome to the show, Radhika, and always a pleasure to speak to you. Radhika, let's start with my first question. Overall, if you talk about the pandemic with regards to COVID in the region, do you think India is the only spot of concern right now?
Hi, Hiral. Glad to be speaking with you. I hope I'm audible. Certainly India is a watch factor because I think the net accretion to the caseload, the net addition is still at a global high between 350,000 to 400,000. But certainly not the only country that's experienced an increase in cases. I mean, if you see the situation, the third highest affected country is Brazil, and there too, apart from just the caseload being high, the fatality rate is exceptionally high. In fact, if you see deaths as per million basis, it's multiple times of India. So so there are other parts. I mean, Brazil is one. If you see South Asia, India, South Asian neighbors are also affected in parts. Then if you see, closer to this part of the region, which is Asia, ASEAN in general, there are Thailand, Malaysia, over north, you've got Japan. All of these are experiencing third, fourth waves. And if you say Thailand, for example, they have put in also localized restrictions. It's heavily reliant on tourism. You've not been able to open the borders, and that's a concern. And they've got Malaysia, it just imposed a nationwide lockdown. It's not as punitive as the previous version last year, but nonetheless, they're stopping people from making interstate movements and all of that. So certainly not alone, I think, in India's case, but I think in terms of scale, India's would still be the highest, and that's why I think there is that source of concern. And I think the final point I wanted to make here is that we should, while we are in the second wave at this point, there is talk that, this is it, this is the worst it can get, it'll only get better from here. I think we should be generally watching quite carefully because in some of the other countries in the region, what you see is that subsequently, when you see a third and a fourth wave, those sometimes are even higher than the first or second wave that they've experienced. So certainly, I think health proofing the population, I think, will be the only way to go for a longer duration support.
Absolutely, yeah. I mean, a lot of regions, like we had Japan, which came out and said that the next wave that they're seeing right now, it's intolerable. A lot of Seychelles, where majority of the population is vaccinated, but now they've started cases increasing. So yes, taking care of on the healthcare front is going to be of utmost priority. Now, with this, Radhika, first 2 quarters of FY21, we did see a major dip that did come in with regards to growth as well. However, there was a slow and steady pickup that started to come in from the third quarter onwards. Again, March onwards, we have seen that hit that has come to India. Uh, what would you make with regards to growth, taking the second wave into consideration for the current quarter?
Uh, Absolutely. I mean, I think Hiral, you've made an important point. I mean, things did get better. I think late last year, we also had, when I say last year, 2020, we had the support of pent-up demand as well as, that downturn ran into festivities. So all of that provided an additional buoyancy for production as well as consumption. I think this time around, things are different. First of all, the solution is that not one size doesn't fit all. So every state is doing its own in terms of how severe conditions are at home. So you've got mobility, and if you see mobility indicators across different states, is different, right? So Maharashtra, for example, is about 35% below normal. Delhi is 30. If you take Punjab, it's almost 50%, half of normalcy. So mobility has plunged everywhere, but it's just plunged by varying degrees. And you also see the wave is hitting different states at different points, right? So it does look like Maharashtra and Delhi, for instance, have now peaked and they're coming off highs. But down south, if you say Karnataka or Tamil Nadu for that matter, their cases are increasing. So different states are getting impacted at different points. And overall health infrastructure also differs between states. I think overall at an aggregate level, if you take hospitals per 1,000 patients, or if you take doctor to population ratios, those aren't great at an aggregate level, but they vary much more on state level. So I think the impact, that's why this time around is different. But you do see that as the weeks are progressing, more and more states are taking more stringent measures. And we were just speaking before this conversation that caseloads are coming off. I mean, there are signs that overall for the country, the number of cases is coming off. We should just watch very closely if there's a cause and effect, because this also is a time when lockdowns are generally getting stricter, and hence mobility is constrained and then helps the caseload. But overall, I think in terms of growth, we might subsequently discuss this, but in terms of growth, we do have a double-digit contraction, sequential contraction quarter on quarter for the June quarter, which is the first quarter of fiscal 22.
Right. So with this, if you have to extrapolate FY22 right now, RBI is forecasting a 10.5% growth in terms of FY22. And yes, obviously, it is going to be on a really low base if you have to take FY21 into consideration. But do you think in absolute terms, a double-digit growth is something which is going to be achievable? Or do you think it's going to be far-fetched, taking the current situation and scenario into consideration?
I think there are two aspects to the growth trajectory this year. We should remember that we are at the start of fiscal 22. So I think no surprise that the first quarter is going to be very deeply impacted. Oddly, though, we will still perhaps see the year-on-year number turn out to be in double digits. I think it's a matter of whether it's going to be 15% or 20%. We do see that, year on year, you're going to see those kind of numbers. So sequentially, but there'll be a contraction. But second half of the year will be equally important to watch, because I think unlike last year when we came out of the first wave and there was a general build in confidence pretty fast, this time around, I think people will be much more cautious, because you do worry, and you see in the region, you also see that subsequently there have been multiple waves as well, and vaccine rollout has been more gradual. So I think we should see the differentiator factor this year into fiscal 22. And the central bank's forecast is where our forecast is as well at 10.5%. And that's why we haven't changed it as yet, because if you see the consensus, it was much higher when we started off 2021, and all of those are now, closing into our forecast. So I would think end of the day, we might land up with about 9.5, 10% kind of full year growth forecast, which again, year on year buoyancy because of what's happened last year. But if you see the ultra high frequency data, certainly showing visible impact, right? Mobility we discussed, and peculiarly what you see is that even things like grocery and pharmacy, which is essential movement, that has also fallen to lows, like May 2020 lows, and of course, I think mobility, what happens is it's a bit magnified, right? Because that can capture really people's movement, but that does not necessarily mean people are consuming less. But that does show you the extent of concern from households, from people in general, and also concern in terms of the states, governments putting in restrictions. You can talk about traffic congestion, vehicle registrations, all of that, has corrected. But there are some silver linings. I mean, if you see GST collections in particular has done well. So the data indicators are quite mixed at this point, and some of the corporates, the feedback has been that till April they did have the cushion of higher stocks, and demand held up pretty well, but into May they are expressing a bit of concern. So in all, I would think that the central banks, as does ours, forecast does have a slight downside bias, but I think it would be in the region of say a wide range, but 9 to 10% would be the growth number that I think most will settle in for the year.
Right. So with this, another important aspect that we have been looking out for is with regards to inflation management and how RBI is going to look at it, because clearly COVID restrictions is something that will constantly keep influencing inflation for the rest of the year. And there is a risk coming in that, with regards to where if the inflation keeps rising, RBI's monetary policy easing becomes risky right now. So, how important is that going to be? Because already, if you talk about the commodity prices, they've touched the roof. How will it change the RBI's stance as well?
Certainly, I think besides the pandemic, even if you take it as a global level, besides the pandemic, I think the inflation outturns is a very important point of concern. I mean, if you talk about the US right now, it's a close tie between whether inflation will be a bigger issue for them or labor markets, which might, decide where the central bank eventually takes rates or the markets takes rates. For India's instance, I think it's important to know what inflation looked like last year. We should remember that while we had 6 to 7%, even higher inflation, much of the region was in fact negative readings or very low inflation. So there is a base effect in play as well, which will, I think, hold up in 2021 for India. And coming to your question on commodities, I would think certainly, as has been oft mentioned, I think the outright weightage in the CPI basket is quite small. In fact, the WPI basket is almost double of what the commodity weightage is. So there you can see the numbers from 4% to 7%, and data out shortly might show it upwards of 9% year on year. So there it's quite obvious. I think the commodity upcycle is showing, but inflation not so much. So on the year, certainly, I think the inflation and commodity upcycle coupled with slight supply side constraints. I mean, right now we have seen restrictions being tightened, and there might be some fallback in impact on supply chain. So both of these put together, we might see inflation, firm up. But for the year, barring this base effect, I mean, if you just net it all out, there are some months with high base effects, some months with low base effects. If you just net it all out, our inflation number is at about 4.8% for fiscal 22, which will mark a step down from last year, which was 6.2%. But nonetheless, I think if you see under the hood, if you see the component breakdown, you will see certain pockets where it will be more evident. And just deviating a bit from inflation is corporates, right? So corporates last year enjoyed high margins. Input prices were low, but this year around, input prices is eating into their margins as well. And the final point for central bank, I think they, just like they did last year when inflation was even higher, I think the flexible inflation targeting regime allows them to tolerate few months of overshoot if it is predominantly supply driven. And at this point, certainly it doesn't look like growth is the reason why inflation is high. So I don't think they're going to react. So there, I think eyes are firmly on financial stability and giving the required growth impetus. So we don't see any reduction in rates, and we certainly don't see any increase in rates.
Right. So with this, very interestingly, as you mentioned about the banking sector as well, how do you think the second wave is going to impact the sector? Because already there was an anticipation that bad loans would increase in the first half of FY22. Now, with the second wave hitting us, with the other clues that have come in the form of a moratorium, etc., do you think FY22 overall will see a major increase in terms of where bad loans are concerned, and that's something which could hit the banking sector as a whole?
Certainly, I think I'll borrow a few from the previous point that we discussed, where the central bank has done its bit in providing support. And what has happened with the banking sector as a whole is certainly they will face flag. The provisions that were allowed last year, which was extraordinary, right? You had moratoriums, and there was also a cap on basically freeze on accounts being classified as NPA. And gradually, just starting off this year, late last year, the central bank was slowly drawing out all those extraordinary measures because it did look like the bulk of the heights of the COVID problem was behind us, and then it would allow for the banking sector to turn a corner as well. But here we are, facing a second wave. So for the banking sector, I think the aggregate data is not out as yet, but if you see anecdotal commentary, what we noticed there is that the retail loans, so there was a recast window that was available for the corporates as well as SMEs, and what you saw is the take-up rate, number one, was not that high, not as high as at least the markets were expecting or banking sector themselves were expecting. So that was quite small. And secondly, if you see some of the private sector banks, it seems to suggest that more retail loans in terms of value was recast rather than corporate loans. So there is, I think the devil is in the details, in the sense that If you see last year's example, the recast take-up was not that high, and I don't think that's why you would see a huge increase in the NPA ratio. I mean, our own, I'm not a sector analyst, but if I were to just take a ballpark, 1.5% of net, or 1 to 2% net increase in NPA was possible because of the first wave, and you might see half of that happen in the second wave as well. Because again, we will have to go through this entire next 6 months or so to realize, what is the take up like, and thereafter, in a couple of years when this recast runs its course, to if any of that turns bad, what is the impact on the banking sector. But overall, I would think that there is certainly going to be pressure. Provisioning that they have done ahead of the curve helps, but we would see, I don't want to take a hazard a guess, but I would think that not a very sharp increase, but some pressure on the NPA accounts is certainly going to be the case.
Right. And with this now, you have the monsoon which is coming through. IMD Radhika is forecasting an average monsoon in 2021. Simultaneously, another aspect that we have to consider right now with regards to growth is how rural India is being impacted. In the first wave, you mainly had urban India, which was impacted by COVID. And this time you have tier 2 cities, tier 3 cities, as well as rural India, which is one of the biggest growth engines which we were relying on for growth, is getting impacted. Now, clubbing the monsoon forecast as well as COVID hitting rural India, what do you make of it? I mean, are we already encompassing this in our estimates?
Certainly. So let me answer the question in two parts. The IMD forecast does bode well for monsoon and hereto for crop production as well. It just means that, for the third consecutive year, we're going to see normal or above normal rainfall. Certainly, when rainfall does start, you will have the spatial and geographical distribution, which will assume importance to make sure that all the the land across gets sufficient rainfall and in time. And last year, the farm sector was certainly a very important support for growth. In fact, even in this cycle, I mean, farming activity is being allowed, is one of the few sectors that can continue to function. But as you see caseloads increase in the rural sector, that is certainly a point of worry. And I think I would take this beyond, farm sectors usually used synonymously with rural areas. We do know that over the past few years, that mix has past a decade or so, the mix has somewhat changed. In fact, now 2/3 of rural area activity is to do with manufacturing, with non-farm activities, and say manufacturing, construction, and all of that. And employment, it's also more than half of the employment comes from rural areas. So from these parameters, I think it's quite important to gauge how the rural part of the community does, because there is that tail risk back into urban areas as well, considering much of the MSMEs are also based out of the rural areas or semi-urban areas. So to answer your question, whether at this point, I would think not in entirety. There is a certain amount of risk expected. I think penciled into, again, this June quarter GDP, but I don't think the risks are being reflected fully. And also this remains quite uncertain, to what extent it will last, and what particularly if it also hurts the informal part of the sector, that doesn't necessarily show in our GDP numbers immediately. So I think these are questions that need to be answered over the course of the next few months. But I would think part of this slowdown is likely reflected in the aggregate numbers.
Right. And with this, now that we're talking about that, yes, the government probably could start supporting once again the MSMEs and people below the poverty line due to the partial lockdowns, or probably the slowdown that we could see in the economy. Do you think the government will be able to achieve their fiscal deficit budget that has been laid down? And how do you see the action by the global rating agencies because of that?
As far the government is concerned, I think the moot point is that last year the emphasis, rather than doing just a nationwide stimulus like some of the Asian countries did, what the government decided to do was to do more sustenance kind support, where making sure that the economically vulnerable households got sufficient, say, food supplies, and vulnerable parts also had cash support. Apart from also supporting the rural employment scheme. And I would think that that kind of bent will continue this year. You already seen part of some of these, the food grain bit at least being announced. And because now the states are taking a a bigger role in the lockdowns and making decisions about their own geographies, they are also doing their bit. So in some ways there is a handover from just the central government support to more state government participation in this point. So I would think that over the next couple of months, if these restrictions stay, you would see more income supports coming in from the state governments. So overall, in terms of, to answer your question about the fiscal deficit part, I would think there is certainly some things that we should watch out for. I mean, fiscal deficits, one part of it is the stock, which is, how much is the fiscal deficit for the year? And the other thing is being compared to as a percent of GDP. And usually when the nominal GDP is used here, and you would see, not surprisingly, that even though real GDP might slow down a bit because of higher inflation, particularly in WPI inflation, where deflators are, you could roughly see them between CPI and WPI, that will provide a natural lift to the nominal GDP. So to some extent, your deficits will not look very worse off from what the government has assumed. Plus, I would think if there is a need to do more on the stimulus front, there will be a reprioritization of categories away from capex and more into revenue support. And so this is on the spending side. And very quickly on the revenue side, GST is holding up. Fuel taxes are still holding up, so that also provides some natural buoyancy. So overall, for the states plus center, I would think that the overall deficit would stay around 11% of GDP this year. And so that would, I think, perhaps be a slightly smaller than what happened in fiscal 21.
Right. And very lastly, with the current scenario that we are already taking all the macros into consideration, what's the kind of movement are we expecting with regards to bond yields and the Indian rupee? Because that's something which is of importance right now as well.
Sure. So I think for both these factors, you have to take a top-down and a bottom-up approach. Top-down let me talk about the bond markets very quickly. What you've seen is that the cost of financing, and if you talk about government bonds in particular, compared to Jan to 2020, the bond yields have come down across the board, partly because of the dovish central bank policy, partly because the central bank has also played a very important role in your overall, supply management for bonds. So if from here on, I would think that there is a bit of an upside that we see in the long end of the yield curve, perhaps another 20-25 basis points from this point towards the end of the year, mainly because while the central bank will provide very important and continue to play a key role in the bond markets, the other domestic participants, particularly the banks, if growth comes back and if credit demand goes up, that appetite might not be there like last year to participate in the domestic bond market. And then you also have to watch what happens in the global markets. US rates have bottomed down and heading up, so there might be some effect there as well. And that taking that to the rupee view, we do hold a house view is that the dollar will not stay as low as it is in the past a month or so. We do think dollar will head up from here and stabilize in the second half of the year, which means the dollar rupee has another 2-3 rupees to go before it reaches stability. So we do think the dollar rupee would be in the 76 handle later this year.
Right. So that's something we should be watching out for as well. Thank you, Radhika, so much for joining us on the show. Always a pleasure to have you and get more insights from you. Stay safe. I hope you enjoyed the conversation as well, and speak to you soon again.
Thank you very much, Hiral, and all of you stay safe.
Thank you.